Hello friends, myself Rohit. I'm sharing learning of this book, Kalpvrksh Chapter 13, Mutual Fund. So mutual fund is like a group of investors coming together to put their money in stock, bonds, short-term debts. While investing in mutual funds, we are actually buying a share of that fund, which represents a portion of ownership in the overall fund. So how does mutual fund work? We need to understand NAV, net asset value, which represents the price at which we can sell or buy our mutual fund investments. For example, we invested rupees 500 and with the NAV of rupees 10, then we receive 50 units of the mutual fund. The NAV changes daily, and with the increase in the value of stock, NAV also goes up. For example, NAV goes from 10 to 20. The investment which was 500 earlier will now be valued at rupees 1000. So this increase in value is known as capital gain. And while redeeming are mutual fund units, the gain on loss is subjected to capital gain tax, which is applicable only at the time of selling our investments and not during the investment period. It is further classified into short-term capital gain tax and long-term capital gain tax. SEBI, Securities and Exchange Board of India, has classified mutual funds based on structure and based on asset classes. Based on structure, it is open-ended, close-ended. Open-ended, where we can enter and exit as per our convenience, and close-ended, where we can invest during the new fund offer period and redeem only upon maturity. And based on asset, it is further classified into equity, hybrid, debt. Equity, where 65% of the money is invested and the high return gives higher risk. It is further classified into small cap, mid cap, large cap. Large cap, like top 100 stocks based upon capitalization. Mid cap 101 to 250, and small cap 251 and plus stocks are small cap funds. Equity linked saving scheme, where lock-in period is for 3 years and eligible for tax deduction under Section 80C. Multi-cap funds gives us flexibility to invest in large, mid, and small caps. International funds, where we invest on companies listed outside India. Index funds, like money is allocated by fund managers in the same company and promotions as the index they are tracking. For example, Sensex. So we'll invest in same stocks and proportion as the Sensex. Debt funds offer more stable returns compared to equity mutual funds, and based upon maturity. Debt funds are classified into liquid funds, where maturity period less than 91 days, overnight funds less than 1 day maturity period, money market funds where less than 1 year is the maturity period, and banking and PSU funds, like money is invested in municipal bond and public sector undertaking. Further, gilt funds, short duration funds. Now comes the hybrid funds, where money is invested in both equity and debt. For example, aggressive funds, where 80% is equity and 20% in debt. Conservative, where 90% in debt and 10% in equity, and balance, where a balance in equity and debt is invested. Now, based on investment strategy, it is further classified into growth funds, like capital appreciation over the long year, value funds, invested undervalued or trading below value, dividend funds, like provide regular dividend income, sector funds in specific sectors such as technology, health, energy, financial services, index funds, as explained earlier, and balance funds, like balanced mix of stocks, bonds, and other assets. So minimum 12% return mutual funds gives us, and by doing SIPs for 10 to 15 years, you can become a crorepati. And before investing in mutual funds, analyze the risk, goals, time, past performance, consult with a financial expert, and take informed investment decisions. Thank you for listening.